Welcome to the Tradescores Market Minutes for January 3rd, 2011. This week I will take a look at the weekly charts of some of the important exchange-traded fund indexes that will help us determine what is going to happen through 2011. I'll also review the reward for risk ratio and describe how it is useful in measuring the performance of your trades. Finally, we'll do a market scan on StockScores.com looking for abnormal stocks and explain why abnormality is something important to look at when you are trading. So here are my ratings for some of the important indexes that I like to look at. Generally speaking, the market looks positive, particularly in equities. Oil I have neutral right now, although it is in a short-term bullish trend. We're going to see when I look at the chart that it has some resistance that it will be dealing with. The US dollar, which had been trying to rebound, is back to a negative chart, and again I'll explain that when we look at those charts. Let's do that now by jumping over to the tools of Tradescores.com. I have logged into Tradescores and I'm now in the chart watch area. I've created a watch list, which you can all do as well. It's a free tool on Tradescores.com. I've created this watch list of the 7 important charts that I want to look at this week, and let's start off by looking at the chart of the S&P 500 here in this small, what we call the gallery view. You can see that the S&P 500 has been going up fairly strong through the month of December. But let's take a look at the longer term chart. This is now a weekly chart of the S&P 500, and you can see that we've been in a good upward trend since early in 2009. We had a pause through the middle of 2010, but generally speaking, this is an upward sloping channel that the market continues to enjoy. Now, through 2011, I expect that we will get stuck at some resistance, although this upward trend should continue. So look for a short-term continuation of the trend through January and perhaps into February, but expect that along the way we're going to stall at these levels of resistance. And that should be sort of the theme for 2011, a general upward bias, but certainly not a rocket ship higher. We'll get some pauses along the way. The next chart I want to look at is of the Canadian Equity Index. This is the TSX 60 Index Fund, symbol T.XIU, and it too has been going up nicely over the past few weeks in through the end of December, but its long-term chart is actually a little bit stronger than this chart of the U.S. equities because it doesn't have quite as much resistance. It's nearer its long-term highs. So we probably rally up into this zone right about there. The upward trend should continue. We've run away a little bit from that trend. Don't be surprised if it sort of meanders its way higher, but given the strength in commodities, the Canadian market should do well through 2011, probably not as well as 2009, which was a really strong year. All right, let's look at some of the commodities now. We'll start off with a look at oil. Right here is the chart of oil. And in the long-term sense, we've really been building a base after that strong decline in the oil price back through 2008 and into 2009, and this market is now building an ascending triangle, which it has been doing for nearly 2 years. So the short-term picture is strong because this market's been rallying over the last few weeks, but the long-term pattern here is really a consolidation pattern, one that is building a good base perhaps for a future jump through that resistance level, and that could happen in 2011. I think, however, first what we will have is the market rally up to that line of resistance that I've drawn on the chart, get stuck there for a while, and perhaps later in 2011, as an economic rebound is more expected, we'll get that break through that long-term resistance. The chart of gold is stronger than the chart of oil, although it is probably due for a pullback in the near term. This market has been in a real strong upward trend, and anyone who's traded the gold stocks over the last 2 years is certainly well aware of that. We're now at the top part of our range here, or at least near that top part of the range in that channel. So we may rally a little bit in the short term, but I think at a certain point we're going to get a pullback to support, and that could happen any time. Keep in mind, however, that this chart that we're looking at is a weekly chart, so the rally from here could be a month long before we start that pullback. It's difficult to say. The long-term picture is strong, and I think it is good to remain long in the gold and the mining stocks, but recognize that there will be some profit taking along the way. An important determinant of how gold and oil does is the US dollar, and the US dollar, as you can see here from the daily chart, was pretty strong through November, but it started to suffer as December wore on, and we actually broke down from a falling top. Now when you look at the long-term weekly chart of the US dollar, you can really see that the sellers remain in control. We have this series of falling tops, and that continues to be the case. The downward trend is intact, and I am bearish on the US dollar longer term, at least until that long-term downward trend line is broken. With that said, there is good support down here, and I doubt that the US dollar is going to break through that easily. I expect we'll probably move down in the months to come. That should give us a test of that support where the market will likely bounce on the US dollar. Now, if in fact the US dollar does fall, that should help gold prices, that should help oil. So in the near term, the market here is telling us that we're probably going to see lower prices in the US dollar and higher prices in the commodity markets. The Canadian dollar tends to move in a sort of opposite way of the US dollar, of course, with the Canadian market so heavily weighted in commodities. With the strength in gold and oil that we've seen recently, we're seeing some good strength in the Canadian dollar, and that has it basically at par with the US dollar right now. The pattern that's building on the Canadian dollar is an optimistic one. We have rising bottoms towards a flat top. We're right at resistance now. If the market can break through there, we're probably going to head up toward those old highs, and that is certainly a bullish sign if you are an importer into Canada, but not so good if you are an exporter. All right, the final chart I want to look at is of the emerging markets index, which has had a pretty good last few days. The long-term trend is up, and in the very short term, the market has rallied in the emerging markets. I expect that upward trend to continue, but like many of the other equity indexes, we are coming into some resistance. So expect that the first quarter of 2011 will be strong, and we'll probably get stuck along the way as we move into the second and third quarters of 2011. All right, let's move along now and look at some of the other things that I had planned for this week. This week's StockSchool is all about reward for risk. This is an effective way to judge trading performance. Now, people tend to judge their performance based on the amount of money they make, the percentage gain that they have, the success rate, how often they're right versus how often they're wrong. But they should also include in their statistical analysis of performance the reward for risk ratio. Now, the reward on a trade is relatively simple. It is the difference between the entry and the exit price on your trade. The risk is the difference between the entry and the stop-loss price. Now, the reward for risk multiple is how much you make relative to the risk you take. If you buy a stock at $10 and have a stop-loss at $9, your risk is $1 a share. If you ultimately sell that stock for $15 a share, you have made a $5 profit in exchange for $1 of risk taken, and so the reward for risk ratio is a 5. Now, this is important when you're looking at charts, and we'll jump over to Tradescores where I can demonstrate this point. All right, so we're back into Tradescores.com. I've pulled up a chart of the Bank of America, BAC, on the New York Exchange. Along in the left-hand side of the control panel is a little area here that we have called risk reward. You can see here I've entered in the entry price of $12 and a stop loss of $11.50, and that ultimately determines the lines that you see over here on the chart. The red line is the stop loss at $11.50, and the blue line is your entry at $12. Now, if we bought the stock on that particular day, and that was a potential buy because it broke the downward trend line on that day, we would currently be sitting up here at about a 4-to-1, a little better than 4-to-1 reward for risk ratio. What that means is that this stock essentially pays for 4 losers. Now, if the risk on this trade was 50 cents, and you can see that it is highlighted there on the chart of 50 cents, then if we were willing to take $500 worth of risk, we would buy 1,000 shares of this stock. And currently, we would be sitting with about a $2,000, maybe $2,200 profit, because the current reward for risk ratio is 4-to-1. And that's sort of the concept behind the reward for risk ratio, and it's something that I use in all of my trading, and I encourage you to do the same. All right, the last thing I want to do this week is a market scan on StockScores.com. We'll jump over to that tool in just a moment. This market scan will focus on abnormal behavior, and the reason I like to do that is because abnormal price and volume trading action is indicative of significant fundamental change. When we see abnormal price movement, either up or down, on strong volume, out of a predictive chart pattern, we often get a resulting trend. And of course, as traders, We want to get into upward trends early or short downward trends early. That is ultimately how we can beat the market. So let's jump over to the StockScores Market Scan tool, and I'll show you how to create your own abnormal activity scan using that Market Scan tool. Alright, I've logged into StockScores.com already, and I've jumped over to the Market Scan tool, which you find under the Tools menu. You can see it right there under Tools. Now, you can use any of our preset scans, and I certainly encourage you to do that. However, it's possible to also create your own market scans using the different filters on this page. So, for example, if I wanted to look through all the NASDAQ stocks that have an abnormal up day, select abnormal day up right there under the abnormal activity filter, and using the volume filters, I'm going to select abnormal volume. I like to set a liquidity standard number of trades, let's say a minimum of 500 trades today. And I'm going to give this a name. I'm going to call this the NASDAQ abnormal. By typing it in at the bottom, I click on Check to Save Scan and run the Market Scan report. It will now go through every stock that trades on the NASDAQ market, and it found 68 that meet the criteria of that strategy. Now, my next step will be to view the charts of those stocks. I do that by clicking on the Select All button and then View in Gallery, and I can now go through the charts 10 at a time to see if not only are they behaving abnormally, but are these stocks breaking from a predictive chart pattern. So here, for example, this NEI, if I blow this up, I can see that there is some abnormal price action right there, abnormal volume, and this pattern is a long-term pennant pattern, and the stock, of course, is breaking out of that. So that's a decent chart pattern setup, and that's really one of the primary ways that I find my trading opportunities. I do the market scan, and then I go through the charts looking for a good chart pattern setup. Here's another one. THLD has been trading sideways for the last few months, but today it made a big strong break out of a rectangle consolidation. You can see that pattern there. There's the break. There, of course, is the strong volume, and that again would be something that I would consider as a trading opportunity. Now, you can see that when I go back to the Market Scan page and I click on Select a Scan, under My Scans, you will see that NASDAQ abnormal, which will always be there for me to come back and use any time that I want to use it, and those filters are now highlighted in green, the ones that I have selected. Well, that has been the Tradescores Market Minutes for January 3rd, 2011. I encourage you to take a look at our two websites, StockScores.com, to use that Market Scan tool, and if you want to try our real-time alerts and analysis service, go to Tradescores.com. You can subscribe on a 14-day trial. Go to the sites, StockScores.com and Tradescores.com, to learn more. Have a great week in the market and trade well.